Okay, everyone, here we are now dealing with another issue regarding our path to going from actual to optimal debt ratio. Basic idea is very straightforward. It's going to vary the path, right, from one firm to another. It could even be different with the same firm at different points in time. So, what's our big picture? We're looking at the right kind of debt. We're trying to match financing with the asset characteristics, right? And this completes the financing principle part of our analysis, right? So let's dive in. When you have a firm under or over levered, the natural reaction of an analyst is looking at the numbers, so the firm should fix the problem. And of course, in a kind of classroom setting, the idea is fix the problem basically immediately. All right, can't do that. You could be wrong in your assessment of optimal. You might have misestimated your optimal, in which case you have to backtrack and fix things, right? I mean, if your recommendation was followed, backtracking could be very expensive and even fatal. And also the macro variables could shift. Interest rates and risk premiums could change, and your recommendations might prove being wrong under such a situation. And of course, you got adjustment costs. This refers to changes in the capital structure, which basically cause the company to be managed differently. It imposes a new environment upon decision makers. They're not ready to make that shift. Managers at highly levered firms have to make decisions differently than managers at the lightly levered firms. Increasing a debt ratio for a firm overnight can create pretty large adjustment problems for the managers. Now, studies have looked at the firm likelihoods of being taken over in a hostile takeover, and they conclude a few things. The small firms are more likely to be taken over than large ones. The closely held firms are less likely to be taken than the widely held ones. Firms with anti-takeover restrictions are much less likely to be taken over compared to firms without the restrictions. And of course, firms that have done well for their stockholders, so they have positive Jensen alphas, positive economic value added, right? Those are less likely to be taken over than the poorly operated firms. Excuse me. And whether a firm is under bankruptcy threat, basically you can assess that by looking at its rating. If it's a B rated or less, you would argue that it has a real threat of bankruptcy, basically. And remember, if you look at historical data, say on return on capital, return on equity, relative to the cost of capital, cost of equity, you shouldn't rely on that to be the same in the future. The firm's future might look very different from its past. So, reviewing this is a little easier to detail if you look at it in terms of Disney. So here's Disney being analyzed around 2009. And we'll assume any future projects are going to be pretty successful. And of course, assessments have changed. In 97, Disney would not have been a takeover target. It had a high market cap and good performance. Back in the year 2000, it would have been a takeover target. Its market cap had dropped, and its performance was quite bad on accounting and stock price returns. In 2003, we probably would have pushed for higher dividends. Disney was earning terrible returns on capital, and at that point in time, we didn't really trust management. So that's what we would have liked to have happen. What you need to do here is map out your firm's path to the optimal ratio, and it depends on two things. The first part is urgency. If you're a likely target for an acquisition or there's a bankruptcy threat, you got to go for immediate change. Otherwise, you would want to go for gradual change. But secondly, if your stock performance has been pretty poor, say the Jensen's alpha is negative or your project choices have yielded some negative excess returns, so economic value added winds up dropping below zero, you probably want to go for a recapitalization, paying off debt, buying back equity. And of course, if you have some good projects that are viable, then go for some investments as your option. I mean, just common sense. If good projects are on the horizon, right, got to put that new money into those projects. Going at it quickly, if you want to change the debt ratio, use either a pure recapitalization, where the assets remain unchanged and you basically just change the liability side, or you do a little bit of a mix and change up both sides of the balance sheet. Now, which one you adopt depends on the market you're in. When you have capital markets that are open and liquid, it's really easier to do a recapitalization. It also depends on the nature of your assets, right? The liquid assets are going to be easier to sell. And it depends on the magnitude of the change. Right? The bigger changes are much more likely to require you to do some mixed strategies. Now, when debt ratios changed over time, the big complication is that the firm value itself changes over time as a function of new investments, remember, and you got this issue of the expected growth in the equity and debt values. So you can put it another way. If you try to get to 40% of the firm value 5 years from now, it's going to be more complicated than going to 40% right now, right? Because there's timing issues. Since the firm value 5 years from now, right, is different from our firm value today, and you have growth factors to consider and new projects coming into the mix of the firm over that time period. And that gets to the basic idea behind designing debt. Your objective is this: issue securities that bring you all of the tax benefits of debt, but give you as much flexibility that you get as when you have equity. It's not the reduction in risk here, but the increase in the debt capacity that generates the value. See, a firm that does not use this debt capacity won't gain from matching the debt to the assets in the first place. So keep that in mind. So note a firm that goes bankrupt here in 2 periods when the firm value falls below the value of its debt. So that's as time goes by. That's a big problem, right? So what you need to do, in essence, is have a firm that would never go bankrupt. It might have borrowed more or less over time, and it might have borrowed even a lot more, but now it never goes bankrupt because it's matching the value of the debt to the firm value across time. So we get into the issue of being really creative, basically, to try to design what we'll call a perfect bond. The idea is to design debt that looks and acts like equity in terms of the cash flows. So you have several key aspects to watch for. The duration question. Companies that might have long-term projects like Boeing do long-term debt, right? Companies like short-term projects, say Dell, they need to use short-term debt. Second element is the currencies. If companies get a high proportion of their revenues from non-domestic operations, they should probably use more foreign currency types of debt, especially if you get a currency mixture that's really stable in value. Thirdly, inflation, right? Companies with some pricing power have the ability to pass inflation on into their cash flows, by raising prices. So those companies could be much better candidates for floating rate debt because the interest expenses on that debt rise and fall with the inflation rate. And then you have the issue of a growth pattern, right? Mature companies with level, steady cash flows are better candidates for straight debt. But if you're a growth company, you're going to want to have convertible debt so that you can have some of that equity variation built into the instrument. Now, the tax authorities are going to come into the picture here. Of course, not is all lost, shall we say, if they don't let you subtract interest expenses for tax purposes. It's possible that you could get an increase in your tax benefits by deviating from a perfect bond and just issue the bonds in a particular currency. You could do it a wrong currency or a wrong maturity in that process too. So you're just, I think, highlighting here the particular aspects of the analysis. So you get the tax authorities treating you kindly, and now you have the second part of the balancing act, which is actually much tougher to pull off. You have to issue a security that looks like equity to the ratings agencies. It looks like debt to the equity research analysts, and equity for your regulatory authorities, especially if you're a financial service firm. It seems like it could be impossible to set this up. But there are lots of profitable preferred innovations that have succeeded in doing this innovative type of securities design. Investment banks have been doing it for quite a long time, so by their practice, they're showing us that it is possible to do this. So we have this strange case called trust preferred stock. Just a comment on this, the ratings agencies have been learning over time very slowly. And as they've developed their knowledge about the trust preferred stock, the investment banks have been coming up with newer securities that have similar objectives. They were, oh, it looks like this is equity, okay, but then you get a little more savvy and it makes sense that it's actually only partially equity. And they're doing a better job of sort of analyzing such securities. Let's look at this little application. Basic answer, you should expect the under-levered firms to gain and the over-levered firms to lose when they do this. The over-levered firms might fool the rating agencies, but they're going to lose because their expected default cost is rising. That's going to wind up being a problem for them down the road. And here, you got bondholders, and you're trying to allay their fears a little bit. So you put these conditions into the debt, and it might make it less attractive from the point of view of the firm, but it might actually be the only way that the firm can borrow under this kind of a scenario. And while you're doing all that, you got this issue. You might have a market mistake that has arisen. You might feel that your equity or your debt is undervalued, and you don't want to get locked in to that undervaluation. So maybe you should use short-term solutions. So we could call this bridge financing. And as that occurs, you wait for the market to be valuing the firm more accurately. And once you're a little more sort of comfortable with the valuations that are arising, then you switch away from the bridge financing. So the bridge financing method is usually short-term debt and short-term warrants, as Professor Demodorn points out in the text. And now design here brings it all together, and I'll stop on this slide. And you see the framework moves you through these different aspects that are part of the design of proper debt. See, you begin by matching up the financing type to the asset type, thinking about duration, currency, growth patterns, and special features. When you're doing this, here's the overall key, right? You're trying to reduce your risk of bankruptcy. You're trying to increase your capacity to borrow, and, of course, the ability to get the tax benefits right from debt. So you get perfect debt, and then you modify it, right, for tax issues. That way you get the maximum tax benefit in terms of the statutory environment you face. You want to meet the needs and the objectives of equity research analysts and the rating agencies. You need to fix any agency conflicts that prevent lenders from lending. And you want to prevent a low rating from pushing up your costs of debt higher than it really should be. And if you're underrated, you should probably use short-term debt, right, until you feel that the rating is actually justified. So let's put this one up as our first entry into our timing and design question.